Hi, everyone. This is Jason Barrack of Wall Street from Main Street. Welcome back for another Wall Street from Main Street podcast interview. We're talking about oil today. Rick Roll, who was on in the last couple weeks, also Dan Steffens. They were outlining the valuations for oil and natural gas companies, some of the absolute cheapest valuations there for profitable companies, companies generating free cash flow. They have not cut their dividends. We're at West Texas Intermediate crude oil prices. They're on the lower end of a trading range, a little bit of a rally this week, still barely above $60 at $61.88. I think at one point a couple days ago, I think we bottomed out maybe around $58. The natural gas prices started to have a rally. I think like the demand side for natural gas is a lot clearer, especially with all these data centers that are under construction. Today's special guest is a returning guest. He runs for over 20 years now a paid oil and natural gas newsletter. Folks, this is all he does, and he is very, very good at it. He covers all the large caps and medium caps in the oil and natural gas sector and the pipeline companies. Elliott Gue, thank you for joining me again.
Oh, thanks for having me on the show.
And Elliot worked at other newsletter companies in the past. He runs the Energy Income Advisor with my former boss and also his co-founder there, Roger Conrad. So, Elliot, I want to get your thoughts on oil supply and demand because, the sentiment right now, I think a couple months ago, the sentiment for the oil market, I think it was the lowest amount of oil bulls on the oil futures contracts, I think in history, I think I saw in one place. And now whenever I interview oil experts like you or Dan Steffens or Rick Roll says nice things about oil and natural gas, I just get super long, nasty, like troll comments on social media saying the oil edge is over. Why won't you interview electric vehicle experts or solar, wind, biofuels, battery experts? Like, is like that. Do you think that that's a good sign that the bottom is close?
I do. I think oil is one of the most hated commodities I've ever seen in my career. Certainly as hated as it has been at some of the key bottoms in history, like 2016 and 2020. You mentioned the futures market positioning. Obviously, I look closely at the Commitment of Traders report that comes out of CFTC, where they actually tell you, what the speculators or non-commercial traders, what their positioning is in futures. And typically it's a contrarian indicator, right? When everybody's excited about oil and long oil in the futures market, that's usually a sign that you might be looking for a top or at least a correction or pullback. The opposite is true when those commitments are very low, when they're quite bearish, when speculators are quite bearish oil. CFTC hasn't released the data since the end of September because of the government closure, right? But at the end of September, we were at 15 plus year lows for net commitments on the non-commercial side. So the lowest levels we've seen since the summer of 2010, right? So very bearish on oil. I also look on the stock side. I like to look at the Merrill Lynch, Bank of America Merrill Lynch, monthly global fund manager survey, which is actually a survey they do of, a couple hundred fund managers, active fund managers all over the world. And they ask them, a variety of questions about their positioning, what sectors they're hot on, what the key issues they see for the global economy are. And, we see that they are 1.7 standard deviations underweight energy, right? Relative to the long-term average, which for them goes back to about 2001, I believe. They started this survey. So one of the lowest weightings we've ever seen, the most underweight energy stocks we've seen in the past, almost 25 years, 24 years. The only other times in history where we've seen, energy market or the global fund manager survey this bearish on energy and oil in particular were 2016, right, when oil prices bottomed under, under $30 a barrel, and then 2020 when we had the commodity price collapse. Everybody hates oil in the markets, and then on the fundamental side, there's just been a steady drumbeat of, really bad news that's caught a lot of media attention. We have OPEC increasing production, bringing back their production cuts that they, announced over the last couple of years, much faster than anyone expected. They've now pretty much reversed all the production cuts, or they have a line of sight to reverse all the production, cuts, the quota cuts that they put in place over the last few years. You have IEA, the International Energy Agency, which is pretty much openly hostile to oil and has been for years. Forecasting in Q1 and Q2 of next year that there's going to be 4.5 million barrels a day of oil market oversupply, right? Meaning that, global inventories would build by 4.5 million barrels a day, mainly because of sort of weakish, flattish demand growth and all this new oil coming out of OPEC, additional oil production they're forecasting from the United States. 4.5 million barrels a day would be bigger oversupply, a bigger glut, if you will, than we saw in early 2020, right? When, global COVID lockdowns were causing and travel restrictions were causing, a record-setting decline in oil demand. And yet, right, there are also all these actual positive signs out there, which everybody pretty much ignores. The most visible oil market in the world also happens to be both the largest user of oil and the largest producer of oil, right? Also the largest exporter of gasoline, right? And one of the largest exporters of diesel would be the good old United States, right? And unlike the CFTC, the EIA has continued to the U.S. Energy Information Administration, part of the Department of Energy, has continued producing their weekly oil inventory stats. And what we can see here in the United States is that, oil inventories are well below, about 6 or 7% below the 5-year seasonal average for this time of year. We have gasoline inventories a little bit below average for this time of year. We have distillate inventories, which includes diesel fuel, right, and heating oil, also about 6 or 7% below the 5-year seasonal average. We also have very strong demand. All summer long, U.S. refineries were operating at 5 to 7-year seasonal highs in terms of utilization of refineries. Demand from summer driving season was record-setting this summer. You saw, if you look at the numbers from the Transportation Security Administration (TSA) for the number of passengers moving through U.S. airports, July of 2025, which is the peak of travel demand, was stronger than 2024, 2023, 2022. Go back through their entire data set. Demand has been very strong. U.S. exports of gasoline and diesel fuel have been very strong. And you have, global oil inventories, which are not, announced or reported as frequently as the U.S. We see OECD, basically developed world oil inventories, relatively low. You hear talk of, well, maybe it's because, China is building up their own strategic petroleum reserve. And they certainly are. While they don't report it like we do here in the United States, we have satellite tracking data. We can see the new storage facilities being built. At one point this summer, April, May, up and through August, I believe, you saw Chinese building their strategic petroleum reserve, which is their basically government-owned stockpile, at as much as a 1.1 million barrel a day rate. But, ask yourself, why is China buying all this oil and storing it? Well, in my mind, the answer is probably not, they're completely stupid, right? The answer is they probably think that, better to buy oil to fill the strategic petroleum reserve, adding all this new inventory capacity, when prices are where they are today. As you mentioned earlier this week, West Texas Intermediate down around $57 a barrel, which is basically where it was back in April. Brent has been trading in the low 60s. The recent lows have been around $61 a barrel. And so obviously, the Chinese are taking advantage of these low global oil prices to fill the strategic petroleum reserves, probably because they think oil prices are going to be higher in future. So in my mind, you have this incredible disconnect out there between this really bearish sentiment towards oil, towards energy stocks, right? Coupled with all these signs, that the market is still, pretty tight. Low inventories around the world, very strong demand over the last several months. The Chinese buying oil where, when prices are low to take advantage to fill their SPR. You also have the fact that, these OPEC numbers are never what's written on the tin, right? They say we're going to increase oil production, that we're going to increase the quotas by 1 million barrels a day. That's not real, right? A lot of these countries, Nigeria, Libya, a lot of countries in OPEC don't have the capacity to produce oil to their quota because, they physically don't have, the oil infrastructure in place to produce at that rate. They might have a few years ago when those quotas were set, but due to lack of investment in the case of a lot of these countries, they're just not capable of meeting their quotas. The only countries that really matter in OPEC are Saudi Arabia, really, and maybe the United Arab Emirates. They're the only ones who actually adjust their supply as they say they will. And Saudi Arabia has increased its oil production, but it's only a fraction of the big headline numbers of millions of barrels a day, that you see, touted in the mainstream media. So, to me right now, oil as a commodity, oil levered energy stocks, right, are hated. They're very out of favor. They're very cheap, right? And that's kind of what I like to look for when something's out of favor, and but the fundamentals are kind of mixed as they are for oil right now. I think that's likely to be an opportunity if things are really as bearish as the IEA says they are. Right? How come oil hasn't been able to break below $57 a barrel here all year in the United States? How come Brent hasn't dropped below 61? How come all these calls for, I've seen calls for $40 a barrel oil, right? Which if oil prices actually drop to $40 a barrel, do you know how fast global production would decline, especially outside, OPEC? And so, I think there are, I can't tell you that, oil prices are going to bottom tomorrow or that we can't go down to, $55 a barrel. But, I can have a high degree of confidence that with sentiment so bearish, this is not when you see the start of an oil bear market. Think back to 2014, when, sentiment was very bullish on oil. Oil prices were over $100 a barrel. That's when you see, a big decline in oil and energy stocks, not, 2025 with sentiment
Well,
in the trash can and these stocks very cheap and everybody talking about $40 a barrel oil.
Well, I also think you mentioned sentiment, some of the other parts of supply demand. I also think from a supply side on the marginal cost of production, I think now we're in like kind of a danger zone, a trading range area where every $5 or $10 a barrel oil goes down, a lot of marginal production is going to come offline. We saw hints of this. There was a huge energy conference in London, I think in the last like 10 days, 2 weeks, 10 to 14 days. And you had the CEOs there from like ExxonMobil, Chevron, and ConocoPhillips, some of the others. And they were basically saying just to maintain the production, I think in the Permian Basin for the oil production, they have to spend like 15% approximately of their total free cash flow has to be reinvested into capital expenditure. And they said at the current oil prices, there's not really much of an incentive to do so. So we're going to start to see a production fall off probably in the not too distant future.
No, exactly. And that's a key issue. And in US shale, shale or unconventional oil production, it's really kind of a manufacturing business, right? The oil is widely distributed. You have all this prime acreage for drilling. You have a pretty much established well design. Increasing production is a matter of going out and drilling more wells, but it's not quite as simple as it sounds because you're basically running on a treadmill, right? So your existing wells have a very high decline rate. So you put a well online, it produces at a very high rate to start with. But then within a year, production's down 30% more in some cases. And so you have to drill enough wells to offset that decline, that natural decline from your existing wells, as well as to actually produce growth over and above that. So you're right. Companies have to reinvest a lot of their free cash flow just to hold production constant. They can use a little bit less cash flow or a little bit less capex rather, right, to guard their free cash flow, which is what they do when energy prices are low or oil prices are declining. But that the result of that will be a decline in production that will accelerate over time because the longer investment remains low, the more that decline rate catches up to you, right? But I think something that a lot of people are ignoring is it's not just a US situation and it's not just a shale situation. All oil fields around the world decline. There's a natural rate of decline. With a conventional field, you drill a bunch of wells in a big field, say, right? And production ramps up very quickly, reaches a plateau, which hopefully, if you manage it correctly, you can sustain for a long period of time, maybe a couple decades. But ultimately, the underground geologic pressures that drive oil production, you're not sucking it out of the ground with a pump. It's actually a natural flow of hydrocarbons into your well, right? Over time, those natural pressures decline and other drivers of oil production decline. And the actual rate of production in terms of barrels a day coming out of the ground begins to come off. But the problem we have worldwide, there are two major problems I see, right? One is that, actually, I just spent a few minutes there trashing the IEA, the International Energy Agency, because they're so bearish on oil. But while they put out these ridiculous reports about net zero carbon emissions and solar and all this other stuff we can talk about, on the other hand, they also publish these very scary reports about the acceleration in global conventional oil field decline rates. And some years back, I think it was 2010 was the last time they did this. They saw a natural decline rate, meaning that if you don't spend any money on a conventional oil field in the world, you just sort of keep producing, let it produce naturally. Production from your average, well in the world, conventional oil well in the world, would decline something like it was about 4 or 5% a year. They now think it's 8.6% a year.
I
So
think
just
that's
about,
more accurate,
yes,
Elliot,
that's
because
more accurate because it's accelerated over the last 15 years, right? Because
I've spoken to other petroleum engineers like Christine Guerrero and others, and they said that normally, like, they tend to be more conservative about the decline rates, and they expect about a 10% decline rate, and the company has to spend the capex to offset the 10% decline rate. So it sounds like in the past, Elliot, that they were underestimating the decline
I'm
rate.
sure that's true, and they may be underestimating it still today. But I mean, even just using their numbers, let's assume their numbers are correct. They're saying that the natural decline rate is 8.6% a year, but the observed decline rate, right, which is the actual decline rate we've seen historically, right, is about 5.6% per year. So that 3 percentage point difference is because oil companies aren't, not investing in their fields, right? They are going out, they're doing basic maintenance on their equipment, they're doing
Are
well workovers, they're doing infill drilling. In some cases, they're doing things like, carbon dioxide or water flooding to aid production. But they estimate that it takes over $500 billion a year, right? Just to lower from that natural decline rate of 8.6% a year down to 5.6% a year. Not to actually go out and find new oil fields and develop new fields, not to increase production, but just to keep that, natural decline rate minimized. Takes around the world, these companies have to invest over $500 billion a year.
is that on regular conventional fields, deep water?
These
What
are
what?
these are regular conventional fields, and that's the other key point, which I think is not getting enough attention, right? And this is where you start getting into scary town, right? I told you the observed decline rate around the world, which includes that 500 plus billion dollars of investment, is 5.6% worldwide. But it differs greatly between different regions of the world and between different types of conventional oil field, right? If I look at the Middle East is the lowest in the world. It's only a 1%, a 1.8% observed decline rate. And I think it was just a little under 5% natural decline rate if there were no investment. But other places around the world, South America is almost 8%, right? North America, it's more than 8%. And that doesn't even include shale. That's conventional oil fields in North America, like in the Gulf of Mexico or some places in Canada.
Well, I mean, deep
Europe is
water.
almost 10%.
So deep water is conventional. However, your upfront costs are enormous compared to some of the others. So, like, yeah, I've had you on, and you were way ahead of the curve there in Guyana, right, with ExxonMobil and Chevron fighting over that. I mean, but they have to pay all of their capital expenditure costs up front, right? It's billions of dollars up front before they can get that 50,000 barrel per day production or more per the well. Now, the decline rate might be lower because these are amazing wells, but their capital costs up front, what to build out the infrastructure, leasing the oil rigs, it's deep water offshore oil rigs very, very expensive compared to onshore conventional oil wells, right?
Oh, absolutely. And in fact, the decline rates are higher than for conventional onshore oil fields. You're looking for a deep water oil field. The uh, the uh, the decline rate is more than 10% annualized. As I said, compared to 4.4%, 4.2 or 4.3%, I can't remember the exact number for your average onshore field. And add to that the fact that about 70%, just over 70% actually, of all new oil discoveries, reserve discoveries worldwide this decade, so since 2020, right, have been deep water offshore fields. So both of what you said makes a big difference, right? There's all this upfront capital commitment needed to develop these deep water offshore fields, right? So the fact that all the new discoveries are deep water offshore fields means that, there has to be a lot of money put up to develop these new fields. At the same time, it also means that on average, one would expect the global decline rate to continue to accelerate, right? Because if you're developing more and more of these high decline rate deep water fields, that doesn't mean they're not prolific, by the way. That doesn't mean that you can't sustain production by, for example, as you mentioned in Guyana, Exxon is not developing just one field. They're developing multiple discoveries in phases over time. So they're ramping up. I think they have something like 27 discoveries they've made there, right? 26 or 27. And they're developing them up over a period of many, many years. So they will ramp up production from Guyana. It's a bright spot for the world, but there aren't very many Guyanas out there, right? And you have a lot of these older offshore fields that are showing, very rapid rates of decline in production, and there's not enough new fields there to offset that. And the IEA number, kind of gives you an idea of the scope of the problem. They say they say that current conventional oil production worldwide, right, is right around 99 million barrels a day of oil, right? According to their numbers. They say by 2035, even if you invest in existing fields, that's that $500 billion a year I mentioned, you have unconventional shale growth, right? You have all the fields that have been discovered and are approved for development, like Guyana, they ramp up, right? And you have any fields that have been discovered but not yet approved for investment, those are ultimately developed. You still will see global oil production fall by almost 17 million barrels a day, right? By 2035. That's 10 years from now, right? Solely because of these decline rates we're talking about. And I mean, just think about that. To me, that's scary. There's no way. I mean, no matter what anybody tells you about electric vehicles or solar and wind or any of this, nothing's going to offset 17 million barrels a day of global oil demand
Especially for
by 10
transportation
years from
fuels.
now.
Yeah, yeah.
Right, exactly. I mean, people talk about EVs like it's some sort of a magic bullet, but did you know that, light passenger cars, so, your car, truck, or SUV that you have for your personal use, that's only 25% of global oil demand. The
Well,
rest of it is airplanes,
we
freight.
also see this, the proven. I think the other thing that a lot of the electric vehicle people miss is the electric vehicles in a lot of developed countries like European Union, United Kingdom, Norway. It's very saturated, those markets, where a lot due to mandates, a lot of people already bought their electric vehicle, and maybe they'll swap out when one of them breaks down, they'll buy a new one. But in emerging markets, I think the average person doesn't understand, Elliot, that when a consumer has money to to go and buy a vehicle, they're not buying an electric vehicle. They'll probably go buy like an electric scooter, a motorcycle first, maybe a small passenger vehicle. They're going to buy those things first. Those are gas guzzlers relative to electric vehicles. Now, they're not, SUVs like here in the United States, but when they start, modernizing and adapting their economies instead of just public transportation, or China from decades ago when they only had bicycles and China wasn't using that many fossil fuels, there's just tons and tons. People can go watch videos of this, what, in Vietnam or Latin America, just tons of motorcycles and scooters.
No, that's exactly right. And, the big one, of course, which don't think gets enough attention is India. We talked a little bit about this offline, but, India is another country that's, similar size in terms of population to China, very rapid rate of economic growth and development in recent years. And, in my mind, India is basically China in 2001, 24, 25 years ago. And the reason I say that is because every country in history, right? Whether you want to look at the United States, the United Kingdom, you want to look at Japan, South Korea, as a country moves from, emerging market to developing market to finally a developed market, right? Per capita, not just overall energy consumption, but per capita energy consumption goes up a lot. People for the first time in their lives get, home appliances, right, that require energy. In that case, often electricity or natural gas for cooking, right? People start buying cars for transportation. They start traveling on airplanes, which burn jet fuel. They start buying stuff, right, that has to be transported to a retailer near them or online to their doorstep, right? That uses mainly diesel fuel, right? It's very difficult to replace, a diesel engine in a commercial vehicle with electric because they just aren't capable of creating enough range or enough power to haul a large load. So, as time goes on and as a country develops and you have if you will, a rising middle class, right, of consumers, they're going to start wanting the same thing that people in the developed world want. And as you said, there are stages, right? China went through that as well. People first bought, gas powered, motorcycles or small cars. But eventually, as time goes on, it snowballs. And the more people you have that are entering that middle class where they're capable of buying these things for the first time, the more likely they are to do so. Which is why you have so much attention, which is ultimately why you have so much attention right now, for example, on, India, buying oil from Russia. They need the oil because their demand is growing so quickly. Their energy demand per capita is growing so quickly because the country is developing. You saw what happened to oil when China went through this stage, right? Back in 2001, 2002, 2003, Chinese demand just galloping. They went from, a backwater in terms of the global oil market to the world's second largest consumer in the matter of less than 20 years. You're going to see the same thing out of India. You're already seeing it to a degree, and it's just going to continue to snowball. And so, yeah, you might have some reduction in demand from the United States. You already have. Because, when the price of a commodity goes up, people try to use less. I mean, it's just natural. It's economics 101, right? But
Well, I mean, they were saying that electricity demand was supposed to be flat to zero, and now look what's happened with the data centers now here in the United States and the modernization there. So that kind of came out of nowhere the last 3 or 4 years. So I definitely agree in terms of electricity demand, energy usage. I mean, China has modernized a lot of their tier one and tier two cities. They're using a lot of electricity now.
yeah, and they will continue to do so. And most of their electricity comes from coal, right? I mean,
No,
that's the
well,
truth of the matter.
and nuclear power. They're building a lot of nuclear power plants very, very quickly.
They are building a lot of nuclear power plants. They are building a lot of natural gas fired power plants. They are building a lot of solar. But if you look at the actual numbers in terms of in other words, when you look at the news or you see what the media puts out there, they show a picture of Chinese solar capacity going kind of parabolic and outpacing growth in U.S. solar capacity, and that's true. But you also have to remember that China, there is no global energy transition. You've heard this term energy transition, the idea that the world is moving away from the big three fossil fuels, which are coal, oil, and natural gas, right, to renewables. There is no global energy transition because, and I say that because in 1990, right, so 35 years ago, you know, those three fuels I mentioned, coal, oil, and natural gas, accounted for over 90% of global primary energy use, right? Last year, 2024, that was 86.2%. So we've moved away from those big three fuels by 4 percentage points over 35 years. And you're trying to tell me that some of these projections for, global energy, primary energy supply from those three fuels is going to drop to like 30% by 2040. It's ridiculous. It's insane. It has no basis in reality. And at the same time, we talk about energy transition in, your developed Western countries, the United States, European Union. Everybody's talking about energy transition. China doesn't talk about an energy transition. Their energy policy, their official energy policy, is called "Build Now, Break Later." Right? I won't try to pronounce it in Chinese for you, but that's the translation. And the meaning of that is that they're building out their existing infrastructure. So think proven technologies, and they're building out solar, wind, any other renewables that they want to experiment with, battery storage technologies. But they're not going to start disassembling or reducing growth in coal, for example, when renewables are just ramping up. It's like an energy augmentation.
I think they upgraded their coal-fired power plants to the clean coal, so they have the scrubbers in. So they didn't to your point, sir, they didn't shut down their coal-fired power plants.
No.
They just upgraded them to the clean coal scrubbers.
And in fact, they're actually adding to the actual total capacity. You're totally right. And if you look at, for example, India has done the same thing. They're actually producing and installing and building some of the most advanced coal-fired plants in the world right now. A lot of their new plants are actually cleaner than the plants here in the United States that still burn coal. We still get a lot of power from coal, by the way, because those were built in the 80s or the 70s, right? So they're older technology. Now they've added scrubbers and all that to comply with environmental regulations. I certainly have no problem with that, but just the large scale advanced nature of these clean coal plants in places like China and India is actually superior to many of the plants here in the United States, which are much, much older. But on top of all that, China is actually growing their coal-fired capacity. One of the things I like to look at, is over the last 5 years, right? Chinese energy demand has grown quite a bit, right? Now, where has that, not where their total energy comes from, but what have they built to meet that growth in demand? And coal, oil, and natural gas still account for almost 70% of just the growth in demand over the last 5 years.
Is China still building one new coal-fired power plant a week?
I don't know if they've kept up that pace, but it's by far their largest source of electric power in China by many-fold, and it's also it's also one of the biggest sources of not just of total power supply, but also growth, meaning growth in demand for power. In other words, Chinese demand goes up by, say, 19 exajoules, I think, over the last 5 years alone. And a big chunk of that, coal, oil, natural gas have been most of that growth, have met most of that growth. Solar ranks down the list, and all the other renewables are essentially rounding error. If you add in, nuclear, which you mentioned, which they definitely are pursuing, that's also important. But it's very difficult to get away from the big three. Right. And I mean, all right, let me back up and talk about the United States here, right? Through the first 7 months of 2025, the fastest growing source of net electricity generation in the United States was coal.
Wow, I wouldn't have guessed. I would have guessed natural gas because the price was cheaper.
Earlier this year, if you remember, the EIA releases this data with something of a lag, so we only have data through July. But if you look, earlier this year, natural gas prices kind of perked up, and they were actually pretty high heading into June, right, and early July. And so what happened is there are quite a few energy generators in the United States that have the flexibility to fuel switch, so they can switch gas for coal or coal for gas. Now, over the long term, they've obviously been switching more and more capacity over to natural gas because it's widely available, it's much cleaner. These coal plants are old, they're not building new ones. But this year, with the price of natural gas a little elevated, heading into the summer months, for example, and over the winter months, companies that had the flexibility to do so, burned more coal and burned less gas. So gas actually saw a big shrink in net power generation through the first 7 months of this year, and coal actually saw a big step up, far more so than solar. Even for the United States, and I'm not saying that coal is going to become, a growth fuel in the United States. It's not. Over time, gas will gradually take over market share from coal in the United States. That's been the big story for the last 15 plus years. Gas is the number one source of electricity generation in the United States. I think that'll stay that way for a long time because it's not intermittent like solar and wind. But and it's also cheaper, right? And fast to build. But even the U.S., right, with this vast U.S. natural gas supply, domestic gas supply, cheap domestic gas supply, can't totally get away from coal that is easily. I mean, to me, that's pretty amazing and telling.
Well, to add to your points there, I mean, I think in China, you mentioned like their strategy is called something else, but Trump's energy secretary who worked in the oil industry, I like what he's saying because I've been saying similar for years. I'm sure you have too. We need to invest across the board. You add in now this new source of electricity usage demand growth now with the data centers and AI, and we really, really need to invest across the board. We needed to do that beforehand. Now it's going to get worse. We're just underinvested. I think China has an across the board approach. They're more practical about a lot of their energy investments, whereas the U.S., it just seems every time there's a new regime in the White House or whatever majorities controlling Congress, they have their pet projects for where to redirect the energy investments and the quote unquote infrastructure. But then that it penalizes whichever energy sector is not in favor at the time.
No, that's exactly right. And I would add to that it actually does make a big difference where in the United States you're talking about, because different states have pursued vastly different energy policies. I'll give you a classic example. Two states with some of the largest solar installations in the United States are California and Florida, right? My home state here in Florida. And I mean, it makes some sense, right? Because both California and Florida have a lot of sun. It's a good place to generate solar power. Both states have seen tremendous growth in solar energy generation. Florida has followed more of the China model, if you will, right? Because not only have we built solar capacity, but we've continued to build mainly natural gas-fired capacity. We've extended the lives of some of our nuclear power plants here in Florida, re-permitted them to extend their lives, right? There's talk of maybe even restarting a nuclear power plant that was retired here in Florida. And so, so power prices in Florida, both for commercial industrial customers and for residential customers, is pretty much in line with the U.S. national average, right? California, they've built solar, but they've also closed down natural gas fire capacity. They've eliminated coal from the grid entirely, which we haven't here.
And oil refineries. They shut down refineries too, right?
Refineries, nuclear power plants, they've shuttered, right? All this capacity. Their power prices are among the highest in the United States, more than double what we pay in Florida.
They shut down a solar farm too that was built under Obama, I think, like in 2010 or 11. So I mean, they can't even do the solar part right. Basically, like the state of California is a mess with all their energy policies and their infrastructure.
Well, you know as well as I do that if you subsidize something, you're going to get more of it, right? but you're also going to get bad investment. You're going to get marginal projects, right? Because people are just
California
trying
is
to.
even worse than that. I mean, they straight up like those government contracts for those projects. I mean, a lot of those funds are stolen. I mean, there's like rampant charity. There's people at the highest levels of California government. Like I know people in California that are like Gavin Newsom and his wife are doing charity fraud. But let's not. Though that's too far off topic.
No, well, no, I mean, no, but it speaks to the point, and people, and you look at a state like like Massachusetts, for example, right, which could get its gas from the Marcellus Shale, but New York won't let them build a pipeline across New York State, so they have to import their natural gas in the winter. As you know, it gets cold up there from Trinidad, okay, at very elevated prices, at international prices, much higher than what we pay here in the United States. So, my colleague Roger Conrad, who I think you've had on the show before, but he understands the way the utility business works a lot better than I do. But one of the things is, what's the relationship between the individual regulators at the state level and the major utility? In some states like California, it can best be described as very hostile. So it's very difficult for, a company in California, a utility company in California to say, hey, you know what? We're going to invest the hundreds of millions of dollars it requires to upgrade the infrastructure to build all this new generating capacity. If you're going to be constantly suing us, denying our rate increases, all this other stuff, in a state like Florida, there's a much cozier relationship between the regulators and the utility. The utility files a plan, the regulators approve the plan. It's just a lot easier to get things done in a state, in some states than others. So, yeah, the national policy makes a big difference. But, I'd point out, even here in the United States, um, you have vastly different energy policies between states in the United States. And as a result, you have vastly different energy prices, electricity prices between different states in the United States. And it's
Oh
a
yeah,
major competitiveness thing, right?
You said some
Why do you think
Marcellus
this?
field, right? That's the natural gas in West Virginia and Pennsylvania, right? So that's right around where
Yes,
the coal fields used to be. And logically, if things were rational, right, they just put pipelines up there to some of the northeastern states, right, to Massachusetts, New York, New Jersey, no brainer, right? Just put the pipelines there.
absolutely.
But you have the state and local politicians in the municipal level, at the state level, and the EPA, the regulators are all blocking this stuff. So instead of putting like a smaller pipeline there, one state over, two states over, it's blocked. So that natural gas is probably going to end up here in Virginia, Northern Virginia, at a lot of the data centers.
That's right. I mean, that's exactly what's happening. EQT, which is a big natural gas producer in the Marcellus, it's the largest natural gas producer in the Marcellus Shale, the second largest in the United States. They purchased their midstream unit, which was called Equitrans, last year. So they merged with it, they brought it in house. And one of the reasons they did that was because Equitrans owns the majority stake or the large stake in the Mountain Valley Pipeline. Mountain Valley Pipeline goes south through Virginia and interconnects with pipelines that can take that natural gas north directly to the data center corridor outside Washington and in Northern Virginia, right? So and it can also, by the way, send it south for us down here in Florida or down the southeastern seaboard, which is a faster growing, more energy friendly states, right? So that's what's happening. And then the other side of the equation is, I think it was called the Constitution Pipeline, I believe, that was going to go up to, which was denied to New England, to supply gas from the Marcellus Shale just across New York and into Massachusetts and New England, right? That was denied. So what else is EQT doing with its gas, right? Well, they actually have some old coal-fired power plants in Pennsylvania. The Homer City is the largest in was the largest coal plant in Pennsylvania. Very old. It was shuttered, right? It was retired. And what they're doing is they're converting that old plant to burn natural gas, which EQT is going to supply under a long-term contract, not for use by Pennsylvania, right? Not for use by individual residential consumers, but to power a co-located data center they're going to put right there on the site. And they're doing this with two big projects in Pennsylvania. So you're actually literally going to have, a data center right next to a former coal plant, now a gas-fired plant, that can supply power to that data center reliably at a more constant, consistent price.
I'm actually
So
seeing that across the board. So to add to your points there, almost anywhere where there's like kind of cheap natural gas,
yeah,
you're seeing a lot of the tech companies or the utility companies talk about setting up either their own separate source of power or a natural gas fired power plant there to move the natural gas from the cheaper production area to a data center that they're going to build. And they're talking about this in Canada, talking about this in other
Permian Basin, yeah,
outside the United States too. So
yeah,
they already have the Stargate AI facility, which is in Abilene, Texas. That's not that far from the Permian Basin. But
right.
they're talking about adding these data centers now next to natural gas fields in Russia, United Arab Emirates. I mean, there's a Middle East too.
I mean, it makes sense because the grid as it stands today can't handle the growth and load we're going to see over time. And these data centers, they need reliable, always on power, right? So they need reliable source of power. They care about that more than price, right? Really.
Yes.
So yeah, I mean, so that's what I think you're going to see more and more of that. And that's more of a bullish story for natural gas. We've kind of moved from oil to natural gas, but I think it's all relevant. And the point in my mind is there is no energy transition, at least nothing that's going to happen in the next 10, 20 years, where we're going to see a major move away from, those three big fossil fuels, if you will, coal, oil, and natural gas. And so the idea that, which some people have said, right, that that if oil production is really going to drop by 17 million barrels a day by 2035 because of a lack of investment in new fields, right? That's somehow going to be okay because global oil demand is going to drop by 17 million barrels a day. I would be surprised if oil demand in 2035 globally weren't higher than it is today
Okay,
because of
so
things we've talked about, like India, like just the developing world growing faster and faster, and even here in the United States. I mean, we refineries are working flat out, and still, gasoline and distillate inventories are below average.
and those Gulf Coast refineries, they want to blend what the light sweet crude from the Permian Basin oil production, and they want to blend it with heavy sour crude.
Yeah, that's right. And that's actually one of the reasons I really like the refiners here, because your Gulf Coast refiners have a lot of flexibility, right? So they can, both on the import side and on the export side. So they can take oil from the Permian Basin and process that. They can also blend it with waterborne crude oils from places like Venezuela, like West Africa, like the Middle East. And one of the things you do see when Saudi Arabia increases their oil production, which they are doing right now, as I said, the overall OPEC numbers are not correct, right? They're not what's being reported, right? But for Saudi Arabia, when they say we're going to increase production, they do follow through on it. When they increase production, though, what they basically do is they go to a couple of their offshore heavy oil fields and they increase production of their heavier grades of crude oil. Not every refiner in the world can process heavy crude oil. The higher supply of heavy crude oil, the more of a discount that it trades at. So what you're saying is actually very important. Your Gulf Coast refiners are going to suddenly have access to a lot of that cheaper heavy oil feedstock as Saudi Arabia ramps up production. That actually aids their margins tremendously. And then the other side of the equation, which I think is going to get a lot more attention in coming years, is that Europe has closed down a lot of their refining capacity. Some states in the United States, California, have closed down a lot of their refining capacity. The world is increasingly reliant on the U.S. Gulf Coast, right? Gulf of America now, right? Coast I'm talking about, for the supply of refined products around the world. Otherwise, it's just going to be the Middle East selling to Europe because they can't do it themselves anymore because they closed down so many refineries. California has to import oil or has to import refined products because they don't have enough domestic refining capacity to meet demand. And what really made me laugh was Valero has a refinery in California, and they've decided to close it. I think it's supposed to close sometime next year. I can't remember the exact month. But the California legislature, on one hand, they say, oh, our oil demand is going to fall. We don't need this oil. We don't need these refineries. On the other hand, they're trying to sneak this huge subsidy into a bill in California to try to bribe basically Valero to cover some of their maintenance costs to try to keep this refinery open, because they realize if that refinery closes, prices are going to go up even more in California, and they're going to have an even bigger shortage of key refined products. I'm talking about, little things like jet fuel for LA and San Francisco airports, right? I mean, so yeah, it's an incredible story on many levels.
Just bad policy. This is anti-free market, all these policies from the politicians and the bureaucrats, because the free market could fix all these problems. But, the politicians, whenever they get into office, they subsidize or they penalize, they try to ban. There was a lot of anti-fossil fuel rhetoric. Now, we're an investing podcast, Elliot, so I want to get your thoughts here on which companies. I know you cover the largest ones like ExxonMobil and Chevron, Royal Dutch Shell. Are they being aggressive here with acquisitions? Are they looking to go and buy assets on the cheap, like oil assets, now and then waiting, 12, 18, 24 months for things to turn around? Then the deals that they did are going to pay off. Like, I think EOG did a deal like that over the last 10 months. So I think they made an acquisition and the market did not like that they bought oil assets. And they're like, well, we're going to make money on the natural gas. And then the oil assets, like, we got them at a huge discount. And 2 years from now, we're going to make a lot of money on it if the oil price rebounds. I think that was what the management team said in the investors presentation. Are we going to see more of that?
We have seen a lot of M&A in the energy business here in the last few years. I mean, some years back, there were thousands and thousands of very small operators in a place like the Permian. Now there's only a tiny handful of private operators left. Most of them have been snapped up. Most of the companies in the Permian are pretty big producers. So obviously you have names like Exxon, right, which is a super major but has a huge position in the Permian Basin. Thanks to their acquisition of Pioneer Natural Resources early last year, they closed that deal. You also have very, very large, independents, right? Like you have the symbol is FANG. But there's a handful.
Did you hear there were rumors that so that's Diamondback Energy. There's rumors now that ExxonMobil is even considering buying Diamondback too. That's how cheap Diamondback is. That Exxon's even considering buying them too.
I wouldn't be surprised to see something like that happen. One of the reasons I've liked Exxon for so long is that the management team there is focused on a strategy, and I love it, right? It's a strategy of, we have a lot of money. We have a bulletproof balance sheet, right? I'm talking to Exxon here. And they say, when oil prices are low, we can afford to continue to invest when everybody else is having to pull back, right? Can't invest. And that's exactly what they did with that Guyana play, right? Everybody else around the world, BP, Total Energies now, Shell even, they were all pulling back on the oil business, pulling back on exploration development spending, pulling back on anything related to fossil fuels, right? And Exxon was one of the only names to really push the accelerator and continue spending on things like Guyana. Now they have a world-class global oil reserve. I think the organic side is something very important to keep in mind as well. I think we're going to need to see a new wave of exploration. As I said, there's a wedge, right? There's almost 17 million barrels of oil a day that needs to come from somewhere by 2035 over the next 10 years. Exploration spending, overall oil field spending is barely enough to keep pace with the existing decline rate in global oil production. And you're going to need to see a step up in that spending, if we're going to continue to maintain, let alone grow, global oil production to meet rising demand. And,
is Exxon cutting? So I know there was a recent speech at that conference in London, and he was talking about, like, basically that a large chunk of the free cash flow needs to be spent on Capex. Are ExxonMobil and Chevron, are they actually spending on Capex budgets, or have they started to cut back too recently?
They have massive Capex budgets. Sometimes their Capex will vary from quarter to quarter, but generally speaking, for many reasons, one of them simply being that the cost of oil field services, the cost of oil field equipment tends to go down when energy prices go down. And so, a company like Exxon takes advantage of that. They can go out and, contract for these services, contract for drilling rigs at a favorable price. That's why it's so good to invest in the downturn, right? But you're definitely seeing the Exxon and Chevrons of the world continue to invest. And I think one thing that you are beginning to see is your European majors that were kind of planning to abandon oil entirely. I'm talking about names like BP and Shell. They're starting to also invest in the oil business again. BP is talking up. They have a couple projects in the Gulf of America now, that deep water projects that look promising. They also have some stuff off Brazil. So, you're going to see investment from that side as well. But you got to remember, it takes a long time for investment to necessarily show up in the form of greater production, right? So some of these fields that they're talking about now, they probably won't actually be producing commercial quantities of oil, for a few years in the future.
Well, that's
You're
what
going to
happened with
see it.
Petrobras, right? So Petrobras found what in 2007 and 8, they found that
Yeah.
mass amount of subsea subsalts with the deep water offshore oil. It
Mhm.
took them years to bring it online. I think now it's producing around $45 a barrel. It's fairly cheap oil, but it took them a lot longer than people expected to bring the production online.
No, it does. It does. And, a lot of this oil, as I said, 70% of the finds around the world since 2020 have been, offshore, mainly deep water, right? So um, that's where the oil is, right? A lot of the big onshore fields that, have been in production for decades, something like 80% of the world's oil comes from fields that are past their peak of production today. So, and a lot of the new fields are deep water, which have, as I said, an over 10% annualized decline rate. So you're going to see a lot of spending in deep water as time goes on. Now, again, as we're talking about, there's an investment lag. So you spend this money on exploration, it doesn't actually show up in the oil supply for years down the road, right? Um, and these international deep water projects are among the worst in terms of timing. It takes many years to bring these projects on stream, even if you have deep pockets like Exxon does, right? They announced their first discovery in Guyana in 2015, right? So, and I think they announced their final investment decision the same time. So it takes years. But, you know, um, you're already seeing some inklings of this development going on, right? For example, I listen to a lot of these, companies involved in the deep water contract drilling business. And, I started to hear a term which I haven't heard in years now, right? Mentioned a lot, which is the golden triangle. So the golden triangle is, remember from, I don't know, history class, I guess, or whatever, geology, used to be just one big continent, right? And they've all kind of drifted apart over the years.
You mean Pangea?
Pangea, there you go. That's the term. That's the term I was looking for. But if you look at Pangea, if you look at a picture of what they think Pangea looked like, like Africa, right? West Africa kind of fit with South America and the Gulf of Mexico, right? And as the continents drifted apart, that what they found is that a lot of the oil was found in those three areas, right? So you have the Gulf of Mexico, or Gulf of America now, also off the north coast of South America, off the coast of Brazil, and off the coast of West Africa. So a lot of these contract drillers are talking about both exploration and development work going on in those three areas, which we call the Golden Triangle. Again, they were all areas that are geologically very similar because they used to be the same place, right? They were adjacent. You're going to see it. And I think that it's going to be a big story in a few years' time, maybe just 2 or 3 years' time, that there's going to be a wave of investment in finding, also developing existing fields more completely, doing infill drilling or drilling satellite fields in all these deep water areas, because sooner or later, it's going to catch up to global producers that they're going to need to have new sources of oil, new oil and gas projects to offset decline rates from existing fields. And, the subtext of that is that, it ain't going to happen at, $61 Brent crude oil, right? You're going to need prices to be a lot higher to incentivize the level of investment required to offset production declines and grow production. As you were saying, every few dollars oil goes down, it makes certain fields around the world, less and less profitable to produce, or even unprofitable to produce in some
Well, especially
markets.
the Permian. I mean, like, because they have to spend a lot of capex to maintain the oil production. So if the oil price is dropping $3, $5 a barrel every couple of
Yeah,
weeks, I mean, there's just no incentive to keep reinvesting to grow production then.
no, that's right. And a lot of people say, oh well, so and so producer said that they can generate flat free cash flow or cash flow break even in the 40s, $40, 40 something dollars a barrel of oil. And that may very well be true. But, it's not like a company is going to say, you know what, we're going to keep drilling aggressively until we start losing money, right?
Well, why
They,
burn through your tier
right,
one acre? Why burn through your
right,
tier one
exactly.
acreage at like these prices? Why would you burn through it and run it at losses? It makes sense to cut back then and wait for the.
Exactly. And that's exactly what they do. And the producers say, okay, we could continue drilling and we could make a tiny amount of free cash flow off this or break even. We could continue to most of these big producers, the independents as well as the majors, don't have a lot of debt. They have the financial capacity to do so. But why? Right? Why sell oil at 61 or $57 a barrel when you think that 2 or 3 years down the line it may be more like 80 or $90 a barrel, and then you're really raking in the free cash flow. So
Yeah, it
you know
only makes sense to use debt maybe to go buy assets. So if you think you
right.
got a really good deal on some cheap assets that 2 or 3 years from now you're going to make a lot of money on, and you're right about it because ExxonMobil has done stuff like this. So what during the pandemic they made
Hmm.
huge bets with the debt on the Guyana fields and some of their other investments. They paid off the debt very, very quickly.
Yeah, they paid off the debt very, very quickly. And a lot of the smaller producers that have made acquisitions, they've used debt capital and they're paying down that debt, fast. They have plans to pay down the debt. EQT on the gas side, which I mentioned, bought Equitrans. A lot of people said, "Oh, that was really expensive," but the reality is, they had to take on some debt. They mainly because they had to assume debt that Equitrans already had. But they're paying it off very rapidly, and because they have the free cash flow to do so. So, but to me, what you're going to see, the longer oil prices stay where they are, the less growth you're going to see in, or probably the faster rate of decline you're going to see around the world, because you're going to have, shale producers in the United States are going to cut capex because they're rewarded on the stock market by producing more cash flow, and they're not going to want to produce, they're not going to want to spend money if they're not going to generate cash flow with that money, right?
Exactly.
So,
And the European oil companies are learning this the hard way. BP, Royal Dutch Shell, the French one, Total, the Italian one, Eni, they wasted billions and billions of dollars on unprofitable wind, solar, biofuels projects, no
yep.
return on investment, no return on investment, and their shareholders, their pension funds, and the other institutional investors, they all expected no dividend cuts to maintain profitability. But if you're reinvesting capital at 0% returns or negative returns, you can't maintain profitability. So so they've got into this bind now, and I think that's why Elliot clearly Chevron and ExxonMobil have way outperformed a lot of those other European ones because they realized early on that they had to slash the budgets for a lot of these alternative energies. They couldn't spend nearly as much, and I think you're going to start to see what I think it's Chevron. They just announced what they're building. Natural gas turbines, I think, around the data centers there in
Yep.
yeah, so I think they're and then what they're all focusing on liquefied natural gas exports, so they're starting to diversify. So if there's less profits now for oil, I think they'll start to move more of their investments into natural gas pipelines, natural gas turbine power stations around data centers, and LNG exports.
Those would be obvious areas. All the big names will probably spend more money on exploration development projects. Like Exxon still has years of investment to keep rolling through Guyana. Now Chevron, because they purchased Hess, is now a partner of Exxon's on that field. So they're also involved. I think you're going to see the smaller producers out there are going like Diamondback. We mentioned there's another name I really like now, Permian Resources. It's a little smaller. It's quite a bit smaller. Symbol is PR. It's a $12 or $13 stock now, but they're a high quality producer with low debt, strong free cash flow. They haven't been making big deals, obviously, the Diamondback and Exxon buying Pioneer, but they have made some bolt-on purchases within their areas of operations. One of the things I realized is they're a low-cost producer. I think there's a couple of ways it could go, right? One, they could get acquired because they are smaller. They do have prime acreage in the Delaware portion of the Permian, which is the sort of western part of the play. Also, so that could be one way that could resolve. The other way that could resolve is, that they stay independent. They offer a very nice base dividend in the 4.5% range, which is among the highest of any of the producers, the E&Ps, the shale E&Ps out there. They can, when oil prices go up, which I believe they will over time, I think you're going to see $80+ oil within, a year or so. They're going to be able to buy back stock. They're going to be able to pay out a special dividend. That dividend I told you, the 4.5%, that's their base dividend. They believe they can sustain that even with prices down in the 40s. Yeah,
they sound like a takeover candidate. Then, if they're a low cost producer with free cash flow, that a larger company, maybe an EOG or one of those, would look to potentially buy them.
Yeah, or a Devon or a name which a lot of operations in that in the Western Permian, which we call the Delaware Basin. Yeah, I think it could be a takeover target, and I think they could do well on their own if both you're getting paid basically something. 4.5% is not bad. While you wait for either a takeover, or just a recovery in oil prices. When the price of oil goes up, they're going to add to that base dividend. I would imagine either by just increasing it or issuing supplemental dividends or quite possibly buying back stock, depending upon whether their stock's getting credit for, for higher oil prices or not. So there are a few names out there like that left. Again, there's been a lot of consolidation already, especially in the Permian. So there aren't very many small players. And the few private players left are, either got taken out at pretty decent valuations or, maybe they're asking too much for current oil prices, but there just aren't many left.
Are we seeing natural gas and data center and natural gas pipeline specific strategies announced by some of these Permian Basin producers? Because they still have a lot of natural gas. It's a byproduct. They either need to get the natural gas to a power station via pipeline, or they need to get it down to a liquefied natural gas export facility. I think the state of Texas recently said that the data centers, because it would overwhelm their power grid, that they do not want these massive data centers in the Stargate AI one, the phase one just came online. They said they do not want them connected to the main grid. So basically, if you're a tech company, you're a utility. Well, you have to build. So if you're a tech company that's building the data centers, or you're a utility company, you have to build a separate power station there that's not connected to the main grid, so you don't overload the main grid for regular people.
Right. I mean, the ones I've seen on that side have been more in the Marcellus, right? So you have EQT doing that two-part deal, two different projects in Pennsylvania, converting old coal plants to gas-fired plants to power co-located data centers. And the reason they were able to do that, in my opinion, was because they bought Equitrons, they have everything, right? They're a one-stop shop. They have low-cost production, so they have the gas. They also have the midstream infrastructure to help move that gas to these power plants, to be used. In the Permian, there are a few things going on. We have a number of new pipelines that are going to come into service over the next few years. There's the Blackcomb pipeline. There's one, I think it's called the Tequila pipeline, that is going down to Mexico to an LNG facility on the west coast of Mexico. So
And the
a lot of that
Matterhorn one just came online in the last
Matterhorn
like.
one came online a year ago and immediately filled up, and prices collapsed again because there's still an oversupply there. You also have, for example, Diamondback, which we've talked about. The symbol there is Fang. Um, you know, a lot of these developments in the Permian, they're using electric powered, drilling rigs, right, and equipment. And so the electrical load required to manage their operations, that their vast operations in the Permian, is tremendous. So they're actually building power plants to use the gas that they produce in the Permian to power all their facilities, and where all these people live and all their equipment, right? So that's another story. A lot of it's going to be used because a lot of electricity use isn't about you and me with lights and air conditioning. It's also about the heavy industry, right? Refiners. You have chemical producers. You have all that infrastructure. Heavy manufacturing infrastructure also requires a lot of energy, either natural gas itself or electricity. So a lot of it's going to get used by that kind of thing as well. My colleague Roger Conrad was talking about um, Entergy, which is the utility that's down in at the Orlando Money Show we were at. There's a Entergy, which is a utility down. I think they're based in New Orleans, Louisiana, so right there on the Gulf Coast. And they're talking about the load, so the demand for electricity in their base area of operations, their industrial, all these heavy industries that require all this electrical load. It's going to double over the next 5 years.
Wow.
So that's a lot of
Well,
gas.
but they have the Haynesville Shale right in Louisiana, so they do have a local
Yeah.
natural gas supply that's not too far away.
Yeah, the Haynesville, which is another name I like. I think I've probably mentioned on here before, but Expand Energy, the old Chesapeake, they have a vast operation there in the Haynesville. And that's going to be a big winner. But I actually think there's enough gas to go around. You have all these new facilities being built on the Louisiana Gulf Coast to export liquefied natural gas. You have this growth in demand on the Gulf Coast for electricity. There's going to be more than enough demand to support the Haynesville and I think additional supply from the Permian. And as I said, on top of that, you have that pipeline going down to Mexico from the Permian. That's not to supply, Mexican demand for electricity. It's actually to supply a liquefied natural gas export terminal being built in Mexico.
Probably to
And
Asia. Yeah, the gas is probably going
correct.
wherever you can sell it at a higher price to Europe or Asia or Latin America. I mean, it should be going to California. Let's be honest here. It should be going to California, but
Yes.
with the way the policies are, I mean, California is not going to get the cheap energy it needs.
No, 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 it's not. No, it's not. And you also have, by the way, in Canada, there's another story. In West Canada, there's a big LNG plant opening up. It's in the process of opening up right now. LNG Canada or something creative like that, I believe it's called. And it's on the west coast of Canada. And one operator we like up there, Ovintiv, symbol is OVV. They have a gas field up there that's going to supply that. So you also have Canada exporting gas
There's been
to
a lot of
Asia.
mergers and acquisitions too by the Canadian companies, right? So the small and medium-sized ones, there's been a huge merger and acquisition boom the last 12 months in Canada, I think.
Yeah, yeah. I mean, and Ovintiv used to be Encana. Do you remember Encana? Which was a Canadian company back in the day, which is why they have those assets up there.
I get Encana and Enbridge mixed up. Enbridge is the Canadian pipeline company. I think they
That's
changed it.
correct. That's correct. Yeah, and Kana became Ovintiv, so they moved to the United. They re-headquartered to the United States. They had a lot of assets in the U.S. and I think it was a tax and regulatory issue as well, obviously. But then they changed their name from Encana. Um, I'm not. I guess because it sounded too much like Canada, and they changed their name to Ovintiv, which I'm not sure what that even means, but they're still a great producer.
There's so many mergers and acquisitions of the Canadian ones. It's tough to keep track of them all. I think there was quite a few ones just in the last like 6 months. There was a lot of them.
Right, right. Yeah, I mean, and you've seen the industry consolidation thing is something it's been going on for years, but it really accelerated a couple years ago now. A lot of these private operators were just basically waiting to get acquired, and they did get acquired. Some of them for very high prices, but I think prices will ultimately pay out. But uh, again, now I think it's much more. There will be some more acquisitions. Some of these smaller players like Permian Resources. I mean, if they make a small bolt-on acquisition, it's meaningful for their growth, right? A company like Diamondback. I mean, if they and they're doing it all the time, right? Trading acreage or buying small parcels of land, right, in their core areas. It's not going to really move the needle for them. It's just sort of a normal course of business. But yeah, I think a lot of the growth globally is going to be more on the organic side in coming years, where you're going to start to hear more and more about, increased interest in particularly, I think, deep water around the world. And, right now, a
We're
lot of
gonna
these
have to.
stocks,
I don't see
yeah,
growth otherwise. Yeah.
and I haven't looked at them, and I had not looked at them obviously I look at them, but I hadn't looked at them very closely in a number of years. But you've got names like, Valaris, which is an offshore contract driller. We haven't started recommending it yet, but it's a name I have on my radar. They do a lot of these deep water contract drilling rigs. And of course, you have names like SLB, formerly Schlumberger. They're a big player in deep water services, not rigs, but services. Um,
Well, you have Transocean, but you used to have like Seadrill and Diamond Offshore. I mean, like they were so. I think Seadrill went bankrupt 2 or 3 times. The investment
yeah,
bankers in charge of restructuring them screwed that up. They screwed the pooch. Uh,
they are
so
back
that
though. They are back. And it's an okay company. Actually, it was my top pick from uh, 2010. I recommended it in the newsletter I was running at the time, and we recommended selling it in 2014. And I remember getting hate mail about that. Had a nice dividend. People loved it. It had made a lot of money,
the dividend
but
was too
they
large, right?
collapsed.
So like they were borrowing to pay the dividend. So that's why I was where I was like thinking like I looked at that. When you were getting the hate mail, I was looking at their financials and I was like their dividend's too large. It's way above the normal dividend coverage ratio. I was like they're borrowing to pay the dividend. I was like they're going to be in trouble soon. And then we had the huge increase in the oil production with the Permian Basin, the shale boom and the bust, and there was a huge amount of bankruptcies and deep water got thrown into the mix there with a lot of bankruptcies too.
Well, yeah, I mean, basically, Seadrill, which worked for a long time, right? There was a growth in demand for these rigs because of all these deep water developments that were going on at the time. I'm talking about really 2010, which is when BP had that disaster in the Gulf. That's when we recommended it, and all the way up through 2014. But they were talking about $650,000, and this was in 2014. So this is 11 years ago dollars, which is worth more than today's dollars, right?
Oh yeah.
$650,000 a day to lease one of these rigs, right? These advanced deep water rigs. And there weren't that many of them that could handle the really difficult work. So there was an undersupply. So Cedro was minting money, but they needed oil. What they needed was oil prices to sustain um, at a level which was around $100 a barrel on average from 2010 till 2014 to support the kind of day rates they needed on these rigs to pay out that dividend and all that. And what we began to see was oil prices coming down. We felt oil prices were going to go a lot lower, which they ultimately did.
Well, you had
And
the
a lot of these
oversupply from the
contracts
shale
disappeared.
boom. You had the growth for growth's sake there with the shale boom in the Permian and the Bakken, right? People were growing oil production. It was done very inefficiently with tons of wasted shareholder funds from pension funds and private equity. They weren't growing efficiently. They weren't focused, on high profit margins and free cash flow. They weren't low cost producers. So they were growing oil and natural gas production. They were flaring off the gas. They were growing without profits for
No,
years.
that's exactly right. And that's one of the key things that I think about when I think about oil right now. Okay. A true top in the oil market, a true top in energy stocks, you're going to see stuff like that going on. You're going to see people spending untold amounts of money to lease rigs, trying to contract rigs years ahead of time. You're going to see investors, right, getting excited about stuff like fracturing sand companies. I remember a conference here in near here in Jacksonville, Florida in 2014. Everybody was so excited about these, fracturing sand companies that made the proppant needed to produce these shale fields. And the valuations were incredible, and people were just jumping all over these stocks.
Oh yeah, the refiners too. I remember the refiners because the oil kept coming down in price, the inputs, and the people, some of the refiners, the tiny little refiners, some people were making like 500-600% returns on the tiny little refining companies.
Yeah, yeah, and people were very super bullish on oil and on these energy stocks. That's what it looks like at a top. Not a time like now where oil prices are near the lows of a multi-year range. You've got talk of an oversupply instead of talk of a shortage, which you had back in 2014. You've got declining demand for services. These stocks have all been hit lately. Yeah, I mean, it just to
It
me that's the key. At a bull markets feel real bull markets where you're near a top and everybody's excited feel very different than the environment we're in right now.
And in this environment, Elliot, I think as an investor, someone who's written a newsletter for so long, you want to focus on companies that are run efficiently, that are run conservatively, that focus on not overloading the balance sheet with debt unless they're buying an acquisition like ExxonMobil, or they're focused on profit margins and free cash flow. They're not, trying to grow here out of it. Inefficiently. So they're focused on
Yes.
low cost production. They're like, well, we don't know when the exact bottom in oil is. We need to focus on lowering our costs, running our operation more efficiently. I think that's the key here.
No, you're exactly right. In fact, one of the things I tell people is though I feel that, we're near bottom for oil, I mean, we could still scrape along for months before we see, a meaningful surge in a
It,
lot of
it
these
could it
names.
could be a year before we get a big move
It
up.
could
I mean,
be. I mean, I
if
think a year
Trump
from
if
now
Trump
it's going to be different, but yeah, it
well, I
might
mean,
take a
look
while.
what's going on. We were talking about before we started recording. I mean, like the worst case scenario for oil that keeps the oil price in a range is all of those naval assets in the Caribbean, and President Trump and the Pentagon just decide, you know what, we're sending in ground troops, we're sending in the bombers into Venezuela, and we're just going to take the whole country. They're going to take all the oil assets. They're going to tell people publicly we're going in there for the narco trafficking, but one of the other major reasons is they're going in there after the mining assets and the oil and natural gas assets.
Yeah, I mean, there are all sorts of things there are all sorts of things that could happen, and it could take longer to turn than I think it will, and I think it could take months. But that's why you want to focus on those higher quality names. You want to focus on names. You don't want to get too aggressive at this stage of the cycle. We're trying to find the trough of this cycle, and you don't really
So,
want to focus on high cost, expensive stocks or really shaky stocks, particularly on the oil side. Gas is a different story, but
so you mean for high quality names for our listeners, for example, you mentioned a few of them, but some of the really high
yeah,
quality names, you mean like dollar cost averaging, not trying to pick the exact bottom, adding to positions here on weakness. Maybe if there's another $5 drop or $10 drop in the oil price, go and buy some shares of ExxonMobil or Chevron or EOG or Diamondback or some of the other ones that you mentioned. Ed.
yeah, exactly. And on the refining side, for example, I would look at a name like Valero, which is the largest independent refiner. They've been through all these different cycles. They have great assets. A name like that, on the midstream side too, I would stick with some of the bigger names that have pipelines in all the right areas that have a long operating history, a history of not cutting their distributions when things turn south. Names like that, even a name like Permian Resources I mentioned, that has a nice yield, low cost of production, low debt. These are names that they'll be fine if prices kind of scrape along a bottom for 6 or 12 months and then ultimately benefit on the other side. And when the cycle gets going, it'll be time to start looking down the cap scale at some of the sort of more exciting growth areas, some of the more niche markets. So yeah, I'm on the oil side. I would stay conservative for now, but I do think we're going to be talking about a very different world in the next couple of years, where once this exploration and development cycle gets kicked off, there are going to be a lot more areas to look at. And before this is done, before this cycle is done, much like the period from the late 90s up until 2014, which was the last big cycle, investors are going to be very excited about all of this. The S&P 500 energy index won't be 3% of the S&P 500 as it is now. it'll be more than 10%, I would imagine, before this is done, which was the previous high. But yeah, we're at that stage of the cycle where you have to play it a little conservative because the timing is a little difficult. The gas side, I think you can get a little bit more aggressive in some stuff, but I think that the growth story on gas, the catalyst for gas prices to rise from AI power demand and also LNG exports, those are the two big ones anyway. They're more obvious, they're more visible, right? Um, but yeah, I mean, I think oil is definitely the bargain. It's out, as I said in the beginning, I like to look for stuff that's out of favor, and maybe that everybody's already bearish on. There are not a lot of sellers left out there. Everybody's already pricing in the worst for oil and for a lot of these companies. And there's a lot of room for upside surprises. And I think that's what you're going to see in oil over the next year or so.
Yeah, in Canada, let me add to your points there as we wrap up here. The Canadian oil company, the mid-tier one, Whitecap Resources, they did a $15 billion merger with Veren earlier this year, and they already announced after the acquisition went through, because oil prices are lower, they announced a substantial decrease in their capital expenditure budget. I think they were planning on spending about 2.6 billion, and they already slashed it by $500 million capital expenditure down to 2.05 billion. And they said that their capital expenditure budget will be adjusted further down if oil prices are weak. So that's despite all the pipelines, the new Trans-Canada pipeline, what that's going from the Calgary, Alberta fields, Edmonton, Alberta fields to the west coast there, and the LNG export pipeline, that terminal that you said is coming online, the natural gas pipeline. So even though there are the pipelines there, the prices are low. These companies are adjusting their capital expenditure budgets accordingly.
Yeah, it's not 2013 where companies were growing for the sake of growth because production growth caused their stock price to go up, right? This is a very different world. Investors are only interested in free cash flow, and the ability to pay dividends or buy back stock and things of that nature. So if
Agreed.
you go to an energy conference, what do you hear about? You hear people sitting there saying, well, modeling how much free cash flow can such and such company generate at X dollar oil, X dollar natural gas, and it's just a very different place, and that's very healthy for oil prices. What you just said, these companies reducing their capex means less production, lower supply, and I think that's probably a major reason why these EIA expectations for 4.5 million barrels a day of excess supply early next year are just not going to come true.
Yeah, I agree. And also to add to your points there as we wrap up here, if the CEO, the senior executives of these oil and natural gas companies, if they start to spend lavishly on capital expenditure or other projects, I think buying assets with cash flow is fine. But if they spend too much on capital expenditure and there are dividend cuts, if their profit margins aren't good, if they're not focused on running the operations more efficiently, maybe cutting costs, there will be management replacements. So, and in
Yes.
this environment, the CEOs running these companies, they would rather slash the capital budgets, the capital expenditure, and run things more conservatively, even after they did an acquisition, than risk being replaced.
No, absolutely. I mean, you've listened to any energy conference call of a company that makes any kind of an acquisition, and just watch the CEO and the CFO usually get just peppered with questions from the analyst community. Did you overpay for it? All this. Did you overpay for it? What's the idea? All this. People are very skeptical,
Well, that's what happens in a bear
right?
market, right? Your question,
Yes.
every little detail's question. Can you
Yes.
survive? Are you going to go bankrupt?
Hmm.
All that. And then 2 or 3 years later, when the market turns and the company's minting money with the new assets of free cash flow, then people just pretend like that they never made mistakes there.
They're going to say, why didn't you buy more? Right?
Yeah. This is unfortunately this is part of human nature now, and a lot of these
Right.
Wall Street analysts at banks. Yeah, everything's what have you done for me lately, pretending that they
Right.
didn't make any mistakes themselves.
That's for sure.
Well, Elliot, I always enjoy my energy conversations. I want to thank you so much. We're seeing. I'm just seeing a lot of classic signs that this is a contrarian value investment here. The valuations are cheap. I think we're going to see some of these companies. The rumors going around. We were talking about this a couple months ago. BP was going to get bought. They didn't get bought, but the rumors now going around are that ExxonMobil is even looking at Diamondback.
Yeah, I would not be surprised to see a deal like that happen. I would not be surprised because, you have an administration also which is less likely to oppose M&A like that. The prior administration, it took some time for them to close their deal to buy Pioneer. This time around, I don't think that would be an issue. And so you could see M&A like that for sure. And certainly some of these smaller players like we talked about.
As we wrap up here, please tell my listeners where they can find your research.
Well, absolutely. My main service is Energy and Income Advisor, energyandincomeadvisor.com. I also have a Substack where I publish a lot of free content on energy. And we also just launched a new service on Substack, totally focused on energy. I'm doing it with my friend Roger Conrad. It's called the Energy Bulletin. And you can find all of that at freemarketspeculator.substack.com. And I also love to reply to comments. So if you have a question or a comment about anything we talked about today, feel free to go to freemarketspeculator.substack.com, type your comment in there, and I'll get back to you.